Hello everyone, welcome to Quiet Money Journey. This is a channel where we talk about money in a calm, realistic way, without hype, without selling dreams, and without pressure. If you are a Malaysian working in Singapore, or planning to work there, this video is especially for you. Many Malaysians work in Singapore for 10, 15, or even 20 years. Some live frugally, some sacrifice family time, some commute every week. And after all those years, some people finally reach a big milestone, 1 million ringgit, or even more. So the big question is this: should you put that 1 million ringgit into EPF? This is a very common question, but also a very emotional one. Some people say EPF is too slow. Some say EPF locks your money. Others say EPF is the safest thing you can do. Today, let us break this down in a simple, practical way. No jargon, no hype, no financial influencer tricks. Just clear thinking, real numbers, and real-life decisions. First, let us talk about what EPF actually is. EPF, or Employees Provident Fund, is one of the most stable and conservative investment vehicles in Malaysia. It is designed for retirement, not for excitement. Historically, EPF has delivered around 5 to 6% annual returns over long periods of time, and those returns are tax-free. There are no management fees. There is no need to pick stocks. There is no need to check prices every day. And there is no emotional stress during market crashes. That may sound boring, but boring is often exactly what works for retirement money. Let us look at real numbers. If you put 1 million ringgit into EPF, and EPF delivers an average return of 5.5% per year, that is about 55,000 ringgit per year. That works out to roughly 4,500 ringgit per month in passive income. This is not imaginary money. This is real cash flow that can pay for groceries, utilities, insurance, and basic living expenses in Malaysia. If you plan to retire in Malaysia, 4,500 ringgit per month, without touching your principal, is meaningful. Now, let us talk about liquidity, because this is where many people feel uncomfortable. Money in EPF is not fully liquid. It is locked until age 55, with partial withdrawals allowed for housing, education, medical needs, and certain approved investments. So if you are planning to use this 1 million ringgit in the next few years for business, migration, starting a company, or major lifestyle changes, EPF may not be suitable for the full amount. EPF is not emergency money. EPF is not opportunity money. EPF is retirement money. But if this money is truly meant for your later years, EPF suddenly becomes very attractive. Now let us compare EPF with keeping the money outside. If you keep 1 million ringgit in fixed deposits in Malaysia, you are likely earning around 2.5 to 3.5% per year. The good news is that fixed deposit interest in Malaysia is not taxed. The bad news is that returns may not always beat inflation over the long term. If you invest in stocks, unit trusts, or exchange-traded funds, returns can be higher, but so is volatility. You may see big gains, but you may also experience large drawdowns. Not everyone has the emotional strength to stay invested when markets fall sharply. If you invest in cryptocurrency, returns might be very high, but risk is also very high. For many people in their 40s or 50s, this level of stress is simply not worth it. EPF sits nicely in the middle. It is stable, boring, and reliable. And for retirement money, those are not bad qualities at all. There is also one major advantage that many Malaysians working overseas overlook. When you contribute voluntarily to EPF, you are building retirement income in ringgit. If you plan to retire in Malaysia, your future expenses will also be in ringgit. This means you reduce foreign currency risk. You are not worrying about exchange rates when you are older. Your income and your expenses are matched in the same currency. This alignment is very powerful, especially for people who earn in Singapore dollars today but plan to live in Malaysia later. However, there is an important limitation that you must understand. There is an annual voluntary contribution cap of 100,000 ringgit per year. This means you cannot put 1 million ringgit into EPF all at once. You will need to spread the contributions over several years. This forces discipline, but it also means EPF should be part of a broader strategy, not the only move. So what is the smart approach for most Malaysians working in Singapore? For most people, the answer is not all or nothing. A sensible strategy looks like this. Gradually channel a core portion of your savings into EPF every year, respecting the annual cap of 100,000 ringgit. This locks in safe, tax-free returns for your retirement years. At the same time, keep a portion of your money liquid. This gives you flexibility for emergencies, opportunities, or unexpected life events. If you are comfortable with risk and have experience, you may allocate a smaller portion to growth assets outside EPF. And if you prefer zero-stress returns, allocating some money to Malaysian fixed deposits can also make sense. This is not about chasing the highest return. This is about building a system that you can stick with for 10, 15, or 20 years. If you are in your 40s and planning to retire in Malaysia, EPF is not a bad deal at all. In fact, it may be one of the most underrated wealth tools available to Malaysians working overseas. So should you put your 1 million ringgit earned from working in Singapore into EPF? The short answer is this. Yes, for long-term retirement security, but not blindly, and not all at once. Quiet money decisions rarely look exciting. They do not impress people at dinner parties. But over time, they quietly build real wealth and real peace of mind. If you found this video useful, like the video, subscribe, and share it with someone working in Singapore right now. This is how calm, boring decisions build a secure future. I will see you in the next video on Quiet Money Journey.